Adjusting entries related to accrued revenues are necessary to get revenue properly recorded when it has been earned. If cash is not collected at the time the revenue is earned, an adjusting entry is prepared to recognize the revenue. The adjusting entry results in recording the revenue before cash is received. Accrued revenues often occur in situations involving rent, interest, and services performed. On January 1, Phoenix Consulting invested $300,000 in securities that earned 5% interest per year. The journal entry on January 1 is debit or increase the asset account investments and credit or decrease the cash account. The entry is posted to the T accounts. At the end of January, Phoenix Consulting has earned 1 month of interest that will be recorded through an adjusting journal entry. Interest is determined by the formula interest equals principal multiplied by the annual interest rate multiplied by the amount of time the interest is being earned. In our example, 1 month's worth of interest is calculated by multiplying the principal amount of $300,000 by the given annual interest rate of 5%, and then by multiplying that by 1 divided by 12 months, because interest is only being calculated for 1 month. The amount of interest earned to be recorded is $1,250. The adjusting entry at January 31 is to debit or increase the asset account interest receivable and credit or increase the revenue account interest revenue. The adjusting entry is then posted to the T accounts, so the accounts will accurately reflect that a receivable exists and 1 month of interest revenue has been recorded. Adjusting entries for accrued expenses are similar to adjusting entries for accrued revenues. The expenses have been incurred, but no cash has been paid, and the expenses have not yet been recorded into the accounting records. The adjusting entry involves recording an expense account before the cash is paid. Situations that involve accruing expenses include rent or interest expense or taxes or salaries expense. An example of an adjusting entry for accrued expenses involves a borrowing of $200,000 that includes an annual interest rate of 9%. The entry to record the initial borrowing on January 2nd is a debit or increase to cash and a credit or increase to the liability account notes payable to record the debt that is owed to the bank. The entry is then posted to the T accounts. On January 31st, the company will prepare an adjusting entry to record the 1 month's worth of interest expense related to the liability notes payable. The interest formula, once again, is principal multiplied by the annual interest rate multiplied by the amount of time the interest is being calculated. 1 month of interest is $1,500. The accounts involved in the adjusting entry are a debit or increase to the interest expense account and a credit or increase to the interest payable to recognize the fact that 1 month of interest expense needs to be recorded and to reflect the interest liability that exists at January 31. The adjusting journal entry is then posted to the T accounts. Here is a summary of some adjusting journal entries. Note that the adjusting entries include either a debit to an expense account, or a credit to a revenue account. After adjusting entries have been posted, the accounts now reflect the correct or adjusted balances. It is from these adjusted account balances that the financial statements are prepared. The income statement is prepared first and reflects revenues minus expenses to arrive at a net income or net loss. This net income or net loss will be shown on the next statement, the statement of owner's equity. The ending owner's equity balance will be calculated and will be used in preparing the next financial statement, the balance sheet. The balance sheet contains the accounting equation assets equals liabilities plus owner's equity. Next, the statement of cash flows will show the detail of the activity that affects the asset account cash. The adjusted trial balance reflects the account balances for the accounting period being reported. Asset accounts are listed first, starting with the most liquid, cash. Then liability accounts are listed, followed by the owner's equity accounts. The revenues and expense accounts listed at the bottom are used to prepare the income statement, which calculates net income as total revenues minus total expenses. The net income, in this example, $143,650, will appear on the next financial statement. The statement of owner's equity starts with beginning owner's equity balance of $40,000 from the adjusted trial balance. Then net income from the income statement is added, and drawings, if any, from the adjusted trial balance is subtracted. The result is the ending owner's equity balance, in this case, $183,650. The balance sheet reflects the accounting equation and therefore includes the asset, liability, and owner equity accounts. The ending owner's equity balance was calculated on the statement of owner's equity on the previous slide. The balance sheet shows that the accounting equation is in balance. Total assets of $421,150 is equal to total liabilities of $421,150.